So what if the boring quarterly dividend check from your traditional reliable stocks was secretly just automatically buying you Bitcoin?
That's exactly what we're looking at today. It's wild.
Welcome to today's deep dive. Today is June 19, 2026, and the financial world just got this massive jolt.
Oh, absolutely.
Over the last 48 hours, Franklin Templeton, this Wall Street titan that manages over $1.5 trillion in assets, they filed paperwork to merge the most traditional sleepy investment strategy in the world with, well, the absolute high-wire act of crypto.
Yeah, it really is a structural shift in how capital flows. We are seeing a major institution build, like automated financial plumbing, to funnel traditional corporate profits directly into digital assets.
And that is our mission for this deep dive. We're going to look under the hood of these brand new SEC filings. We got a great stack of sources today.
Yeah, we have the actual SEC filing documents for these new DRP Bitcoin ETFs, plus some really fascinating recent academic research.
Right, including that major 2021 study by Choi and colleagues. Plus, we've got fidelity risk analyses and macroeconomic data on crypto correlation.
Lots to get through. We need to figure out exactly how these hybrid engines work, examine the hard academic evidence behind mixing traditional stock dividends with digital assets, and, determine what this actually means for your portfolio.
Exactly. So whether you are someone who meticulously tracks your dividend yields on a spreadsheet, or you're just fascinated by how traditional finance is adapting to the digital age, we are going to show you exactly how the walls between Wall Street and crypto are coming down.
And, the dismantling of those walls really starts with the architecture itself. Franklin Templeton didn't just file for one generic fund.
Right. They filed for two highly specific vehicles.
Exactly. And they are targeting a September 2026 launch.
Okay, let's unpack this because we need to get into the mechanics of what they are actually building here. The first one is called the Franklin U.S. Equity Bitcoin DRAP Index ETF.
Quite a mouthful.
Yeah, seriously. And the sources indicate this one tracks a broad base of about 498 large-cap traditional U.S. stocks.
Right. And then the second one is the Franklin U.S. Innovation Bitcoin DRIP Index ETF, which, as the name implies, leans heavily into growth and innovation sectors.
But the foundational structure of both of these funds is this very strict 9-5 split, right?
Yes. Exactly. 95% of the fund's capital sits in those traditional dividend-paying U.S. equities. The remaining 5% is allocated to Bitcoin.
But the way they access that 5% is crucial. I mean, they aren't just opening a Coinbase account for the ETFs.
No, not at all. They are gaining exposure through a mix of instruments. So things like their own existing spot ETFs, like the EZBC fund they launched back in 2024, along with Bitcoin futures contracts and options.
And they are using VettaFi indexes to manage all of this. Let's define that for you listening, because VettaFi is an index provider. This means Franklin Templeton isn't paying some team of expensive active managers to sit in a room and guess when to buy or sell Bitcoin. VettaFi builds the mathematical rulebook. It is a completely passive, algorithmic strategy.
Which brings us to the core engine of that rulebook, right? The DRIP mechanism. Historically, a dividend reinvestment plan, or DRI, meant one simple thing.
You just buy more of what you already have.
Exactly. If you own shares in a company and they paid you a cash dividend, you didn't just pocket the cash. You automatically used it to buy fractional shares of that exact same company. It was like the ultimate compounding snowball.
But this new SEC filing fundamentally twists that logic. Instead of reinvesting your stock dividends back into more traditional shares, the dividends automatically buy Bitcoin.
Yeah, it crosses asset classes.
And you might be listening to this and wondering, well, why don't I just keep my dividend stocks and manually buy 5% Bitcoin on my own through an exchange?
I mean, that is the most logical question an investor can ask here. And the answer really comes down to behavioral psychology and forced discipline.
Forced discipline, yeah.
It takes a historically aggressive, highly volatile asset and forces it into an incredibly conservative, passive framework. You aren't actively timing the crypto market.
You aren't waking up and deciding if Bitcoin is too high or too low today.
Exactly. You're just letting the natural passive cash flow of traditional corporate America slowly and mechanically accumulate a digital asset for you.
Imagine you own this massive apple orchard, right? Those apple trees are your 498 large-cap dividend-paying stocks.
Okay, I like where this is going.
Normally, in a traditional DYP, you take the apples you grow, you sell them, and you use the money to plant more apple trees in the exact same orchard.
Right, the snowball effect.
But with this new ETF, your orchard has a conveyor belt. Instead of planting more trees, this belt automatically ships 5% of your apple harvest to a foreign currency exchange booth, sells them at market price, and uses the cash to buy seeds for a digital gold tree.
Wow.
You never have to leave the orchard, you never have to negotiate at the exchange booth, and you never have to worry about securing the digital gold yourself. The belt just runs, quarter after quarter.
That conveyor belt metaphor perfectly highlights the automation, but we also have to talk about the brakes they installed on that belt.
Right, because crypto is completely wild.
Exactly, because if Bitcoin goes on one of its historical, absolute tiers, that 5% allocation could easily balloon to 15 or 20% in a matter of months, and that fundamentally changes the risk profile of the entire fund.
So, to prevent the digital gold from basically taking over the entire orchard, VettaFi built in a quarterly rebalancing mechanism.
Yep.
If Bitcoin has surged and now makes up, say, 8% of the total portfolio value, the fund's mathematical rules force it to sell off that excess Bitcoin exposure, bringing it right back down to the target 5%.
There is also a hard cap baked into the filing. Between those quarterly rebalances, the crypto portion is never allowed to exceed 20% of the portfolio's total weight.
So it's a built-in safety net.
Exactly. If we see unprecedented volatility where Bitcoin quadruples in a matter of weeks, the fund's circuit breaker kicks in. It halts the accumulation to ensure that the foundational 95% traditional equity structure remains the undeniable core of the investment.
Okay, so the mechanics are clear.
Right.
We have an automated conveyor belt churning out crypto exposure from traditional stock dividends, and it's governed by strict rebalancing rules.
Right.
But that brings us to the most important question of this entire deep dive. Does the math actually support this? I mean, we are mashing up a traditional stock portfolio with a decentralized digital currency.
It sounds kind of crazy on paper.
It really does.
Yeah.
So let's look at the academic evidence on whether combining these two totally different asset classes is actually a sound strategy.
To answer that, we really have to examine the research surrounding diversification and correlation. Historically, the primary argument for adding Bitcoin to a traditional portfolio wasn't just about massive returns.
Right, it was about protection.
Exactly. It was about its lack of correlation with traditional equities. In portfolio theory, a correlation of 1.0 means two assets move in perfect lockstep. A correlation of 0 means their movements are completely unrelated.
Meaning, when the S&P 500 zigs, Bitcoin does its own entirely separate thing.
Yeah, and according to the data in the sources, since 2022, Bitcoin has maintained a low to moderate correlation with the S&P 500. Specifically, it's around 0.53.
Okay, so at 0.53, Bitcoin isn't moving entirely independently of the broader market, but it is independent enough to offer a mathematically meaningful diversification benefit. It provides a totally different source of return.
Right, and the sources cite specific studies from Fidelity on the risk and return profiles of this exact strategy. Fidelity looked at what happens when you add just a tiny slice like 1 to 5% of Bitcoin to a standard 60-40 or an all-equity portfolio.
And what do they find?
The Fidelity research demonstrates that this small allocation can significantly improve a portfolio's risk-adjusted returns over time. Because Bitcoin's annualized returns have historically been so incredibly high, even a 5% slice can pull the overall return of the portfolio upward enough to compensate for the added bumps along the ride.
But we need to be crystal clear on this point for the listener.
Yeah.
It absolutely adds significant volatility to the portfolio.
Oh, definitely.
Even at a 1 to 3% allocation, the Fidelity studies show the overall standard deviation, which is the wideness of the price swings, will tangibly increase. It is decidedly not a free lunch. You are choosing to endure larger portfolio swings in exchange for that higher potential return.
And beyond just the volatility, we have to look at the macroeconomic environment, particularly inflation. Because for years, the dominant narrative was that Bitcoin was digital gold, right? The ultimate hedge against money printing and inflation.
Yeah, everyone was saying that. And our sources include a 2021 academic study by Choi and colleagues that analyzed exactly how Bitcoin reacts to different types of economic stress.
This study is crucial because I think a lot of people conflate an inflation hedge with a safe haven.
Totally. They use the terms interchangeably, but they're completely different financial mechanisms.
Exactly. What Choi's team found is that Bitcoin actually does act as an effective hedge during inflationary shocks. When expectations of inflation rise and fiat currency gradually loses its purchasing power over months and years, Bitcoin has historically appreciated. It acts as a counterweight to that slow devaluation.
But if inflation slowly eats my purchasing power, Bitcoin helps. If the stock market suddenly crashes tomorrow, The study says Bitcoin is crashing right along with it.
That is the vital distinction. A safe haven is an asset that holds its value or increases in value during a sudden, acute market panic. Think of the 2008 financial crisis or the March 2020 pandemic crash.
Right. People flee to US dollars or gold.
Exactly. During those sudden liquidity crunches, when investors are panic selling everything to get their hands on cash, Bitcoin has proven to not be a safe haven. It crashes alongside traditional stocks. It protects against gradual currency debasement, not sudden market panic.
I want to push back on this entire diversification premise, though,
Okay, lay it on me.
because our sources highlight a massive structural shift that happened recently. Back in 2024, the SEC approved the first wave of pure spot Bitcoin ETFs. That approval caused a massive wave of institutionalization. Wall Street totally flooded in.
Yeah, they certainly did.
And the sources specifically note that because of this institutionalization, Bitcoin's correlation to traditional markets has actually increased. So if Wall Street's adoption is forcing Bitcoin to move more and more in sync with the regular stock market, doesn't that fundamentally destroy the diversification benefit that this entire Franklin Templeton ETF is built on?
That tension right there is exactly what makes this filing so controversial. We have to look at why that correlation is rising. As Bitcoin becomes deeply integrated into traditional financial plumbing, it is being traded by the exact same quantitative algorithms, the exact same macro hedge funds, and the exact same institutions that trade, the S&P 500 tech stocks.
So when the Federal Reserve raises interest rates, a macro hedge fund's algorithmic bot is basically programmed to sell off risk across the board.
Precisely. Or if a hedge fund faces a margin call on their traditional tech stocks, they will sell off their highly liquid Bitcoin to cover the cash they need, dragging both markets down simultaneously. The correlation is rising because the player base is converging.
Wow. Okay, so if the math is shifting and correlation is rising, we really have to look at the hidden costs and frictions eating away at this ETF. The theoretical math is one thing, but the practical reality of these SEC filings introduces a whole new set of problems.
Well, absolutely.
Let's start with the regulatory friction.
Well, the most immediate reality is that the September 1st, 2026 launch date is really just a target. As of this recording, the SEC has not approved these filings.
And the SEC has a long history of delaying or rejecting novel crypto products, particularly those that blend asset classes in untested ways.
Exactly. But assuming they do get the green light, the operational risks buried in the fine print are significant. Let's talk about custody. When you buy a 5% allocation of Bitcoin, someone has to actually hold the private keys.
Right, the whole not your keys, not your coins thing.
Exactly. Custody is a major point of friction. The filings indicate they are using a mix of spot ETFs, futures, and options. This means you have layers of counterparty risk.
It sounds complicated.
It is. If they were holding spot Bitcoin through a third-party custodian, you have to trust the security protocols of that custodian. If they are using derivatives like futures contracts to maintain that 5% exposure, you introduce the complexity of rolling those contracts over every single month, which carries its own internal costs.
And because this is an ETF, it trades on an exchange like a normal stock. Which means we need to explain NAV, net asset value.
Right. Net asset value is the actual mathematical worth of all the underlying stocks and Bitcoin held by the fund. However, because the ETF itself trades on the open market, its share price is determined by real-time supply and demand.
So they can become detached.
Exactly. During moments of extreme crypto volatility, say, Bitcoin drops 20% over a weekend when traditional markets are closed, the ETF's share price on Monday morning might aggressively detach from its NAV. It could trade at a severe discount, meaning the price you sell your ETF shares for is actually less than the value of the assets inside it.
Then there is the financial friction of fees. The sources highlight that the fees for these DRP ETFs are currently undisclosed. And in the world of dividend investing, fees are the silent killer of compounding interest. If Franklin Templeton charges a premium management fee because of the complexity of managing VettaFi indexes, crypto derivatives, and daily stock dividends, it could severely cannibalize the very yields that are supposed to be driving the conveyor belt in the first place.
And, the complexity of managing those derivatives leads directly into perhaps the most overlooked and damaging friction mentioned in our sources.
Which is?
Taxation.
Oh, man. Let's break down exactly how a cross-asset DRIP triggers continuous taxable events. Because in a normal DRI, reinvesting your Coke dividend into more Coke stock is a taxable event, but it's a straightforward one.
Right. But when you cross asset classes, the complexity just explodes. Here, the fund is receiving corporate cash dividends from 498 different companies at different times throughout the quarter. Has to take that cash, cross over into a completely different asset class, and buy derivatives or spot Bitcoin. But more importantly, think about the quarterly rebalancing we discussed earlier.
The 5% trim?
Exactly. Every single quarter, if Bitcoin has outperformed the stocks, the fund's algorithmic rules force it to sell that excess Bitcoin to get back down to the 5% target.
Right.
Every time it trims, it is selling an asset. Depending on how the fund is structured internally and how the IRS views these specific cross-asset flows and frequent rebalancing trades, the fund could be constantly triggering short-term capital gains.
Ouch.
Yeah. Instead of a tax-efficient compounding snowball, investors could be handed a highly complex, highly taxable distribution at the end of the year.
So we have rising correlation, undefined fees, custody layers, and potential tax nightmares. What does this all mean for the everyday investor?
It's a lot to weigh.
It is. If I am someone who relies on the stability of a family sedan portfolio, how do I stomach hitting this turbo Bitcoin mode?
Well, it all comes down to the concept of investor suitability, which the sources emphasize heavily. This ETF is fundamentally not designed for someone who needs absolute stability or short-term liquidity.
You have to know what you're buying.
Exactly. You have to understand that you are intentionally taking a traditionally low volatility space and injecting acute volatility into it.
Past performance does not guarantee future results.
It is the golden rule for a reason. This product is strictly for investors with a long-term time horizon. They must have a high tolerance for risk and a deep understanding of how this fits into their own overall diversification strategy. It is a highly specialized tool, not a complete portfolio solution.
Let's synthesize everything we've uncovered from these sources. What Franklin Templeton is doing here is driving the ultimate financialization of crypto.
Absolutely.
They aren't trying to replace traditional stocks. They're using them as an engine. By leveraging the continuous quarter-after-quarter flow of corporate dividends to generate sustained programmatic demand for Bitcoin, they're building permanent pipes between traditional finance and the digital asset world.
Financialization is the perfect description. They are taking a decentralized asset, born on the fringes of the internet, and institutionalizing it through the most traditional corporate mechanisms available.
It is an incredible development, but one that requires immense caution. For you listening, remember to always consult a registered financial advisor before jumping into novel hybrid products.
Yeah, please do.
Invest only what you can truly afford to lose, and take the advice from our sources to heart. Keep your portfolio composing wisely. Do your own homework on the undisclosed fees, the complex tax structures, and your own risk tolerance before you let a conveyor belt start shipping your dividends into digital gold.
As we wrap up, there's one final macro implication hidden in the architecture of these filings that I really want to leave you to ponder.
All right, what is it?
We spent this deep dive talking about what this means for the individual investor, but zoom out for a second. These ETFs are designed to take the cash flow generated by real-world brick-and-mortar companies and systematically use it to buy a decentralized digital asset.
Yeah, the automated plumbing.
Right. So if this hybrid DIP strategy actually becomes the new normal for millions of everyday investors, what happens to the broader economy when billions of dollars in corporate dividends are permanently diverted away from reinvesting in traditional real-world businesses and are instead funneled continuously into the digital vault of Bitcoin?
That is a staggering macroeconomic thought, a totally automated permanent migration of capital out of the real economy. Thank you so much for taking this deep dive with us today. We will see you next time.